Hey everyone, so in this video we're going to go in depth to learn about Vanguard Index funds, mutual funds, ETFs, how they all relate, and how you can get started investing into some of these funds, as well as some of the options that might be available to you. I think there's a lot of confusion around this, and sometimes you might hear people using these words interchangeably, talking about ETFs and mutual funds and index funds, how they relate, and how you can get started with this. So hopefully we can answer some of those questions that you might have, and if not, leave a comment down below and we can help you further on throughout the video. So let's get into this right now. If you're new here to the channel, make sure you subscribe, drop a like, and let's get started. So the first thing we want to think about is when you're thinking about investing into the markets, you want to think about realistic goals. And the overall average growth in the stock market is about 7% per year on average, and there's never been a 20-year span where the stock market has actually gone down over that 20-year period and stayed down that whole time, right? So generally speaking, the markets grow. Now that might not always be the case, but we're pretty sure it will be the case that the markets will grow over the long term. And so because of that, we can invest into some of these different funds that are available to us. Now ETFs and mutual funds, they're very similar in a lot of ways. They both are kind of baskets of stocks. They might hold a couple hundred different stocks or a couple thousand different stocks within that particular fund. So in a lot of ways, they're very similar. But one of the differences between the two is that ETFs generally are a little bit more liquid, easier to access, and easier to get into if you're starting with a smaller amount of money, whereas mutual funds can be a little bit more tricky to start if you only have $50 or $100. It can be harder to get into mutual funds. So Vanguard offers both of these. There's no commissions to buy or sell these mutual funds or ETFs. We're going to talk about expense ratios later on this video and some of the different options that you could think about as well. But what's an index fund and what's a mutual fund before we actually kind of dig into these, because it's very important to realize this, that an index fund is generally a lot more passive. So the way to think about this is that it's passively managed, right? So index funds might track the overall market. They might track the S&P 500 or the Dow Jones Industrial Average, or maybe the NASDAQ, right? But generally speaking, it tracks those stocks, and then if those stocks go up, it goes up, right? But a mutual fund could be actively managed. So you could have somebody managing that mutual fund. Maybe some really smart bigwig on Wall Street might be managing that mutual fund and saying, okay, let's buy 2,000 shares of this company or sell 20,000 shares of this other company, so that they can hopefully try to beat the market or try to beat some of these index funds. So mutual funds, a lot of them that are actively managed, are going to charge you an expense ratio. I don't want to confuse anybody here. Hopefully we're making sense. If not, let me know down below, but I think all of this will make sense by the end of the video. Trust me on this. So mutual funds a little bit more actively managed than index funds. But let's kind of just dig into this, and maybe I can show you some examples here that might be a little bit easier to understand. So for most people who are just starting in the markets, who want to just kind of get their feet wet and start their investment portfolio on something like Vanguard, or maybe you want to use the Robinhood app. You can buy these funds through Robinhood, or even M1 Finance or Fidelity, whatever your heart desires. Maybe if you're not in the US and you're in a different country, you might have a different broker that's available to you, right? But regardless, you want to think about the types of different funds you want to think about, right? So you want, personally, I like ETFs over mutual funds just because they're easier to get started with, right? So let's kind of look at some of the pros of ETFs here. It's called an exchange traded fund through Vanguard. Like I said, no commissions, and there's a lot less risk here. So sometimes you'll see people jumping into the market and buying individual stocks or individual bonds, and in some cases that can be a little bit risky because you're not kind of diversifying. But if you're getting something like an ETF through Vanguard, you're generally going to be diversifying through hundreds of different companies or hundreds of different bonds. That's going to make it a lot easier for you to not lose a lot of money. So it's going to be less volatile compared to some of the other risks that you might get into with individual stocks. It's also a lot less work. I mean, I can tell you this, that a lot of the money that I'm putting into some of these different funds, it just pours in there. And I don't have to think about the earnings statements or what the CEO of Tesla might say tomorrow. I don't have to worry about that because there's a lot less work going into it. I don't have to read the financial statements of a company like you would with an individual stock. I just know if I pour it into something like the S&P 500 index fund, that it's generally going to be okay over the long term, and I'm investing into really the US economy in a lot of ways by doing that, right? So it's a lot less work, which I think can free up time for you to go make money or go do something that you really enjoy doing instead of spending that time trying to make money in stocks, right? So this actually does have a big advantage. You think about the opportunity cost, you think about how much time people spend actively investing versus passive investing, like what most of these funds are going to make you able to do, passively invest, right? I don't spend a lot of time actively investing anymore. I really don't. I put money into some of these funds and I don't worry about it. I don't think about it, and it takes up a lot of my time if I try to do otherwise and try to pick in individual stocks. It's also much lower of a cost. So Vanguard offers a lot of different funds here, and they have something known as an expense ratio. Just about every ETF and mutual fund that you might want to consider buying is going to have something called an expense ratio. And this is essentially a little number that you'll see that pops up that'll say maybe 0.05%, right? So that means that 1/20th of a percent is going to be taken from your portfolio or from the money that you have in this particular fund every year, right? So in some cases, some of these expense ratios can be 1%. Now, if a fund has an expense ratio of 1% and you have $1 million in there, that could be a lot of money. That could be $10,000 that's taken out every year to manage that fund. So that's what an expense ratio is. It's essentially like a management fee. Imagine if you pay a financial advisor 0.5% per year to manage your fund or to manage your portfolio. That's essentially what an expense ratio is. Okay, so you want to keep those in mind as you go through the funds I'm going to show you in this video. You want to keep those expense ratios in your mind, and you want those expense ratios to be really as low as possible. Now, the lowest I've seen on Vanguard is 0.04%. That is probably the lowest expense ratio I've ever seen on any financial institution's offerings for mutual funds or ETFs. So 0.04% is considered very, very low. I personally don't like to invest into anything with expense ratios over 0.5%. So 0.5% or more, I don't like to invest into those because that means that they're taking a pretty large chunk of your investment out every year. And even if that investment goes down, they're still taking that chunk out. If it goes up, they're still taking that chunk out of 0.5% per year. And it can really add up. Maybe if you have $1,000 in there, it doesn't sound like a lot. But if you have $1 million in there when you're getting ready to retire, that can add up to a lot of money that's getting taken out on a yearly basis. So expense ratios, we can look a little bit more into those later on, and I'll give you some good examples of those. But generally speaking, Vanguard has much lower costs than any other financial institution. So I believe the statistic is Vanguard average expense ratio is 0.11%, whereas the industry average expense ratios are about 0.67%. So there's a huge difference between the industry average and Vanguard. And this is why I love Vanguard. And like I said, you don't have to use this specific company to actually buy and sell these different funds, these ETFs. But you can use different ones. You can use Robinhood to buy Vanguard funds. You can use M1 Finance to buy Vanguard funds. You can even use Fidelity to buy Vanguard funds, but you're going maybe to have to pay some different fees depending on the brokerage firm that you're using. But Robinhood, for example, there's no fees on that. Or you could buy it directly through Vanguard, which I prefer to do. So it has much lower costs as a whole, and we've already went over kind of why ETFs could be better than mutual funds, but lower investment minimums and real-time pricing as well. So that is pretty convenient to have. Okay, so let's talk about some of these different funds. This is probably what you've been waiting for, some of the different funds that are available to you. So just looking at Vanguard ETFs. Now, you can also look at mutual funds here. Just click over on the other tab if you'd like to, but I think most people would like to consider ETFs. They're, like I said, pretty similar. But there's 59 different options that we have here for ETFs through Vanguard, right? So we're going to kind of cover some of these different ones here. U.S. bond ETFs, generally seen as pretty safe, and that's because the government is seen as one of the safest options for investing into them. So I'm going to show you some different options here, but you want to kind of keep some of these key metrics in mind. So this is going to be the total gains since inception, and then also the average annual returns for 1 year, 5 years, and 10 years. Now, I want you to be careful when you're looking at these gains since inception. You want to be careful because sometimes you'll say, wow, you know, all right, this one's up 6.65%. When was it actually created? Okay, 2007. So that's actually not bad. But some of these you might see they're created in, 2009 or 2010. Well, if you had great growth on that, they've been in a bull run for 10 years now. So you want to think about when that fund was actually started and how that might reflect on the actual gain on that particular fund. And then you can also look at the expense ratios right here. So 0.07% for a lot of these different US bond ETFs that are available. And if you see these little S here, that's kind of one that Vanguard I believe the term is Vanguard Select ETFs. So these are the ones where if you're, you only pick a couple different ones. It's kind of their recommendations for picking particular funds. But you can look at long-term bond ETFs, but generally speaking, I think it's hard to go wrong with putting something into, total bond market ETF. Very general, very broad, and you can even click on it and see what it actually encapsulates. It probably has a large amount of different variety in here, but its bonds are generally seen as pretty safe. Now, I'm not a financial advisor, so you're gonna have to make your own decisions on this. This video is for educational purposes. I'm not telling you to buy or sell anything particular, and if you do that based off of one video from a random person on the internet, I'd be slightly concerned. I'm just trying to give you different ideas here, but you can look at the risk potential, which I think is important to do for all these different investment options, all 59 of these different ETFs that are on Vanguard's website. You can see the risk potential for them. So for a lot of these bonds, you're going to see them at 1 or 2 or maybe 3 for some of these different like corporate bonds that have lower ratings. But you can see what they're made up of. So we can see the growth over the past 10 years as well and how they fared. So if you had $10,000 in 2009, about $14,000 today if you put it into this particular fund. And that's for a bond, that's not too bad. But let's go back to the main page and see what other options are available to us and how we might want to decipher what we want to put money into, right? But something else you want to think about, with people who are young like myself, I like to put some of my money into things that are a little bit riskier because I can afford that because I'm 20. If you're 59 or 65, maybe you want to think about not risking it too much because maybe you can't afford to lose 20% of your portfolio or 30% of your portfolio in the next couple of years if we have a market crash or a recession and you need to rely on that for retirement. Maybe don't put too much risk out there and maybe kind of play it safer with some of these different bond funds. Once again, though, this is just an idea, not telling you what to do here. Now, investment grade bonds are, a lot of these are corporations. So some of these long-term corporate bonds have been yielding pretty nice returns over the past 10 years or so. So just looking at a fund like this one, right? A long-term one will be seen as a little bit riskier in some cases versus short-term bonds. But these are corporate bonds that you're investing into. So this has a risk level of 3, which is right in the middle. But we can see the composition of this fund, right? So government bonds, pretty high, right? AAA, AA, single A, right? So you can see that these riskier bonds make up the majority of the portfolio here. So these two make up the majority of the portfolio, which are seen as riskier than these ones up here. The US government bonds are seen as the safest options. They're the least likely to default on those loans. And there's not that many in this long-term corporate bond ETF. And that's why it's been performing pretty well because the economy is doing pretty well. But this isn't always going to be the case. But, putting money into bonds could be a good option for people who do want to play it a little bit safer, maybe not put as much risk out there on the table. But let's look at some of these different stock ETFs and one of my favorite options for stock ETFs. Now, by far my favorite, and once again, I'm not a financial advisor, so please don't go out and just do this just because I'm saying this. But one of my favorite is the S&P 500 ETF. So the ticker for this is VOO. It's just VOO, right? But this is one of my go-tos because this holds essentially a lot of different companies within the market. Now, it's also been performing very well. It's been performing out 14% per year since 2010, which the market was very low in 2010. But even at that, it's been doing very well. This is just something that, look, it's going to be riskier. I believe the risk level on this is probably 4. Maybe it has to be at least 4. But for myself, yeah, so it's 4. The expense ratio is incredibly low, 0.04%. You're probably not going to find anything lower than that, so they're barely taking any of your money. There's no cost to get into it. There's no commission to start buying this particular fund, but this is by far one of my favorites. It holds 500 of the largest U.S. companies, so you're essentially just kind of investing into the overall U.S. economy in a lot of ways. And this is more volatile though. And you want to think about this because, like I said, look, if you're not willing to possibly lose some money over the next year or 2 or 3 years, then maybe you want to hold back from something like this. But if you're willing to say, you know what, okay, I might put money into this, it might grow very well, or it could go down a little bit, then that's going to be great. But you can look at their 10 largest holdings and you'll see that, yeah, it's Microsoft, Apple, Amazon, Alphabet. So instead of going out and having to buy all these individual stocks, you can buy a fund that encapsulates all of these, and it can help you long-term with taxes. So in the US, we have long-term capital gains tax, right? And so if you're putting money into these funds and holding them for a long time, your long-term capital gains tax might be 15%, maybe 20%. But if you're doing short-term capital gain or short-term income tax, if you're selling it after less than a year, then you're going to be hit with higher tax rates, especially if you're making a lot of money at the moment. You could be hit with 34 or 39% tax rate on some of these things. But if you're investing into them for the long term, like some of these funds, you could be much better off by just dealing with it by hitting long-term capital gains, which a lot of people will do with these funds. So, you know, if you're buying individual stocks and you're buying and selling, buying and selling, buying and selling, you can be hit with a lot more taxes versus this long-term strategy here. Now, you can also think about just the total stock market ETF. This is a great option as well for a lot of people. But you could, you know, a lot of these different stock ones are going to be seen as riskier. So they'll be at that level 3, 4, or even 5. But the dividend appreciation ETF is also one that I put a decent amount of money into. And you don't have to diversify too much throughout this. So, for example, you don't have to buy all 59 of these different ETFs to make sure that you're fully diversified. You could get maybe 4 or 5 different funds throughout and kind of decide how you want to put money into them. Maybe you want to put 20% into bonds, corporate bonds, and then another 80% into the S&P 500 ETF, right? So it's really up to you on how you want to balance this out. Like I said, personally, since I'm young, I can afford to take more risk, so I put a lot into the S&P 500 ETF, which seems to be performing very well at the moment. Mid-cap stocks, so these are going to be middle-tier stocks, and then small-cap stocks are generally going to be seen as riskier. The risk level on this is probably going to be something around a 5, which is some of the riskiest that you could possibly get. But they also have the chance for growing a lot faster, a lot better. So yeah, so the risk potential on this is a 5. So if you're older and you can't afford this, then maybe hold back from this. But if you can afford this and have that chance for getting very great, fast growth, it could be an option for you. Now, let's just look at some of the other ones on here. There's not too many more that we have on here, but we have a lot of international ones that we can cover very quickly. So we have international bonds, emerging markets, but then we also have some of these different ones throughout here. So international stocks can be seen as kind of risky too in a lot of cases. Emerging markets, I would argue, is one of the riskiest that you could possibly get into. A lot of these have different countries, well, that are emerging, right? So a lot of countries throughout Asia, and I believe the largest holdings for this one, I believe, are like Alibaba or Tencent or some of these different countries over in China and some different countries across overseas, right? And they are seen as a little bit riskier, but they could provide a lot of growth. And we're talking a lot of growth in some of these small cap stocks or some of these different international ETFs, right? But I would caution you to think about, not putting all of your money into something that has a risk potential of 5, because you could lose a decent amount of money in that, and you want to be careful with that. But once again, the expense ratio on this, 0.12%, very low, which is nice to see. And like I said, most of these funds on here have a very low expense ratio overall. I don't think you're going to see anything really in the double digits here, so 0.07%. You're not going to see anything a lot higher than that in a lot of cases. Now, there's also sector and specialty ETFs. So if you're into one particular sector, maybe you want to get into healthcare, right? And you think that the healthcare market, especially in the US, is going to be doing very well over the next 20 years, which I personally believe that, considering how many health problems and how much terrible food and how little exercise Americans do, I think that it's going to be doing very well in the future. So you can invest into one particular sector. Now, not all these sectors are performing very well all the time. So you want to choose wisely on that. And if you're an expert in one field, then that's great. And that's something that you can personally do. But these are the different options that are available to you. I just wanted to kind of show you them and so that you can see which options you might want to choose. Like I said, my go-tos, I just like the S&P 500 index. It's so simple and it's so passive for myself. I'm not a financial advisor. I think I've already said that a couple times, but it's so passive for myself. I just pour money into it and I don't think about it. And you know what? There's some days where your account might go down $2,000 in a day. A little bit scary, right? It's a little bit scary, but the next day it might go up $3,000. So over the long term, as long as you can kind of keep that in your mind that, you know what, long-term investing is a great option for a lot of people. It's the option for me personally, and it could be an option for you. If you're interested in this, I'll leave a link to Vanguard's website. I'm not affiliated with them in any way whatsoever. They're just a company that I think really is a great organization. So if you found value in this video, let me know down below. If you have any questions, leave them down below. I try my best to respond to as many comments as possible. Sometimes it gets a little bit difficult as this channel's been growing. I can't thank everyone enough for subscribing to the channel. So thank you, and I'll see everybody next time.